Hello, everybody. This is Patrick MontesDeOca with the latest Seeking Alpha report that we published on February 26, 2018. Inflation. It is not a case of something that is coming. Inflation is already here. On this report, I would like to examine the inflation numbers, which show indications that inflation is picking up. One of the first areas to show signs of inflation is the food and commodity sector. The grain market, soybeans, corn, and wheat have seen a substantial rally, confirming that the inflation monster is beginning to infiltrate the commodity markets. Some restaurants already have had to adjust to rising costs and a decline in consumer consumer traffic. Chipotle saw a decline in consumer traffic after raising prices 5.7% in response to rising raw food prices. Texas Roadhouse, which reported earnings this week, raised prices only 1% and continued to have some decent traffic growth, but mid-single wage growth ate into the bottom line, and company expects more of the same this year as it holds prices steady to maintain traffic even at the expense of profits. Cheesecake Factory reported that the government is hurting their profit margin by increasing minimum wage, but the government is giving something back by cutting taxes, which helps the company balance sheet. One key question is how these companies that are beginning to feel inflation eat into their profits. How they're going to deal with this new economic trend, pass it along to consumers or reduce their profit margins. A second key question is whether the Fed, in response to inflation, will raise interest rates gradually or aggressively. We need to watch the factors since they could be the catalyst for the acceleration of the velocity of money based on the fear that products are going to begin to rise faster than anticipated based on these recent economic developments. Such conditions may create the fear and panic which may cause the velocity of money, how rapidly people spend money, to take off. If people fear inflation, they are more likely to spend now before the dollar is worthless tomorrow. In doing so, such a situation would create potentially not only an inflationary environment, but a hyperinflationary environment depending on how rapidly the velocity of money expands. US dollar continues to decline. In the meantime, food and restaurant businesses will have to deal with about a 3 to 5% inflation rate, 1% or 2% price increases, and falling profit margins as we take a look at the basis of this economic shift. I want to focus on the US dollar as the leading indicator of inflation. If we look at the US dollar index, it has been in a continuous downtrend since March of 2017 when it traded above 101. We have been in a consistent decline, gaining acceleration to the downside in December 2017 as the market broke the 93 level of support and tested the previous low of 91 that was made in September 2017 before breaking down to new lows around the 88 levels. We are currently trading about the 9-day and 26-day moving averages, which is short-term bullish on the charts, but they seem to indicate that lower lows might be in place short-term, with a potential target all the way down into the low 80s. This trend confirms that the fears that we are beginning to see about inflation are beginning to have an effect as the US dollar declines. In the bigger picture, if we go back to 1971 when President Richard M. Nixon took the US dollar completely off the gold standard, we can see that it was the beginning of the US dollar long decline since the dollar had declined. Since then, the dollar has declined about 98% in purchasing power. There is very little left of intrinsic worth in the US dollar now that we are in an environment of record debt globally. If the government does not change the foundation safety net, which was created after the 2008 Great Recession, we are in a precarious situation. Although some of the spending that is the focus of attention of the current administration may have some short-term benefit, it appears that the long-term consequences would be devastating for the trade deficit and for the debt levels. The government plans to increase the debt ceiling and continue to spend, which will widen the trade deficit and mean that the United States will reach an unsustainable level of debt, especially if, or more likely, when interest rates rise. U.S. and global debt is accelerating exponentially and rising interest rates will probably lead to an exponential increase in the cost of debt. Such a future could prove devastating for global economic growth. Inflation in precious metals. Reports from Main Street via restaurant struggles and economic numbers that are coming out, as well as charts, indicate that in terms of inflation, it is not a case of something that is coming. Inflation is already here. Right now, it may be the perfect time to look at precious metals, which are offering a tremendous profit potential. The markets have completely been ignored, largely due to tremendous manipulation that has and is taking place in the paper precious metals markets, engineered by central and commercial banks, which can sell huge amounts of physical silver and gold that do not exist, in some cases 10 to 1 to the actual availability of the metal itself. Although such manipulation still occurs, it has been a decline as the independence of price discovery has moved to China. With China establishing a precious metals exchange in China, they have regulations that forbid the speculative sale of physical contracts that are not backed by the actual metal. This eliminates what the central banks and commercial institutions have been doing since 1978 in order to maintain the US dollar's role as the global reserve currency. The machinations of the Fed and central banks have kept the US public away from precious metals markets. Their manipulation to keep gold and silver prices low has also wiped out many gold and silver mining companies. Even more now, so with the threat of rising interest rates, which will drive mining companies with heavy debt into bankruptcy. This in turn will create an even greater shortage of physical gold and silver. Debt costs are beginning to be a key factor in the economic growth of many mining companies. A key factor affecting the future of many mining companies will be the rate at which interest rates rise. I believe that the Fed will be behind inflation, as they have been behind the actions of the economy for years. And my fear is that the public's purchasing demand level begins to anticipate an acceleration up in food prices. We could get a stampede that would put a bottom in the velocity of money and begin to see an exponential growth in inflation to levels that we have not seen since the 1970s. Inflation in the price of gold. Gold is becoming the beneficiary of the inflationary developments discussed above. Gold has been traded in the past more as a commodity than as a currency of exchange. However, the fundamentals today, which suggest severe shortages and high and increasing demand, especially from China, Russia, and India, are the opposite of the real price, which has been stagnant or down for years. The amount of gold available is highly debatable. No one really knows how much gold the United States has or how much is in Fort Knox. China and Russia have been accumulating gold aggressively as opposed to the policies of the United States. Primarily, the United States has sought to keep the price of gold and silver down, even at the cost of selling its stockpile, in order to maintain the US dollar as the world's reserve currency. The VCPMI and the gold market. I would like to look at the variable changing price momentum indicator, the VCPMI proprietary algorithm, and what it is telling us as we come into next week for the price of gold. If we look at the trading instructions report from the variable changing price momentum indicator for next week's supply and demand levels, the average price for gold is $13.45. In relation to the first VCPMI filter, the weekly trend momentum indicator with gold closing at $13.30 below the average price of $13.45, it confirmed that the trend momentum has turned bearish for next week. But it also indicates that this trend would change if the market reverts back above $13.45. It would negate this bearish trend momentum and would neutralize it. The second filter that we use with the VCPMI is the weekly price momentum. As we come into next week, 1336 is the average price, the mean or the pivot point price for next week. With the market closing below 1336, we're coming into a week with a bearish sentiment. The VCPMI tells us clearly that if the market were to close above 1336, then this weekly bearish sentiment would be neutralized. The VCPMI is a flexible indicator in that once it identifies the average price, it also identifies the extremes above and below that mean. It provides a structure for the coming week to trade levels where to exit short or long positions. The market closing below the average price of 1336 is a bearish indication. If you are short, exit your short positions at the buy 1 level of 1317 or the buy 2 level of 1305. You should reverse and go long from these levels. If the market comes down to 1317, it activates a buy signal. By closing above 1317, you should put your stop at 1305. If the market comes down and tests the 1305, it would activate two levels at 1317 and 1305. Your stop for both would be 1305 on a weekly close below that level on a good till cancel order. The VCPMI provides precise, clear levels where we expect the reversion to occur. If the market comes down to B1 or B2 level, it is 90-95% certain that the market will revert to the mean. A second close above 1336 activates a signal to exit long positions at the sell 1 levels of 1348 and sell 2 levels of 1367. When the price reaches the sell 1 and sell 2 levels, it is 90-95% certain that the reversion will occur back down to 1336. For those interested in finding out a little more about the VCPMI automated algorithm, we have published a new book, and if you would like to see it, you can go to our website, ema2tradelivesignals.com. We'll show you the where to go right after we complete the podcast here. It is my conclusion that if we combine the fundamental picture, the economic numbers, and the potential effect that rising interest rates and the fear of such an increase is already having on the economy, as we see in the food and retail sectors, the substantial increase in grain prices in the past few weeks, I am beginning to see that the markets are telling us that inflation is here, and we should pay very close attention to how fast it rises. What will make the difference in terms of the impact on the economy is how fast the velocity of money interprets what is happening, and that response could set the trend for what could be either a mild inflation or potentially hyperinflation. In either case, inflation or hyperinflation, gold and silver is a good hedge against an inflationary future. The information in the market commentaries was obtained from sources believed to be reliable, but we do not guarantee its accuracy. Neither the information nor any opinion expressed herein constitutes a solicitation of the purchase or sale of any futures or options contract. It is for educational purposes only.